the idea that there definitely is a consumer slowdown happening, but also that stimulus was so broad and helpful for everybody, it might have papered over a lot of cracks that are now emerging. And where do you think these cracks are deepest?
I think we think about retail. First of all, great to be back. It's been a long time. Good to see you. I think we think about retail as being the zero-sum game. It's the consumer versus the retailer. And COVID eliminated that. Everyone was on the same side. And so what's happening now is everything we keep talking about in terms of the consumer overpurchasing and the consumer overextending, companies did it too. It was the same story. We watched them overbuy inventory, think these lovely times, the stimulus times, were never going to stop. And so now we're paying the price. And so what's interesting is figuring out, you say best and rest. I've generally gone winners and losers. I'll go with yours. But we're in a new scenario that actually looks a lot like pre-COVID.
Sure.
We're just back to...
Is it that the same group that was sort of the leadership then is back in sort of the solid leadership position now? Or have things changed and there's a whole new different set of people that are benefiting or being hurt?
I think yes and no. I think the off-prices of the world continue to push forward. But there's been some special companies in the mall that took advantage of COVID and said, I'm going to change. I'm going to improve the business. Victoria's Secret today is one of the outperformers because they've improved their cash position. They've improved their profitability perspective. And I think that's the trick. I think people are going to figure out how much excess capital they had in their personal accounts because of stimulus and how much because they've changed their spending habits. Companies are seeing the same thing right now.
Absolutely. You mentioned Victoria's Secret. Some of the other companies that you think are doing well here in terms of improving kind of their balance sheet or their position, Mr. Car Wash, am I right in that? Nordstrom.
Mr. Car Wash.
You mentioned Burlington, some of the discounters. Gap is another name as well. So Nordstrom and Gap surprised me a little bit. What do you think they've done right?
Beauty is they surprised me too. So listen, leverage is tied to debt, cash, and EBITDA. Everyone is seeing their EBITDA come down this year. Hopefully they'll see it improve next year. Cash is the big trick. And so I think Mr. Car Wash is a separate instance, right? I mean, this is its own special beast. And
Why is that even in your coverage universe?
That's a conversation over drinks. No, they're a really good company. But I think, listen, everyone needs a car wash in their portfolio. But the other businesses is interesting because we're watching some of this. And part of the debt analysis is more to figure out who's in trouble than who's in a good place because you don't want to show up in the debt report. It's not like, oh, we get really excited about how low your leverage is. Great, right? I mean, certain dose of leverage is
better
healthy.
If you didn't have it at all, sure.
I think like one of the questions we looked at VF Corp, so VFC, where if I'm inside that boardroom, I'm wondering, should I be cutting my dividend?
Really?
And so one of the interesting analysis we did was we looked at who has big fixed costs, who has a big fixed debt pay down coming due, and how does it correspond to their own profitability, their own EBITDA. And so next year, VF has half of their EBITDA that they need to refinance.
Wow. Wow.
And it's a fixed cost.
And that's in a very high interest rate regime.
Exactly. And it wasn't when they started. And that's why we're looking at the fixed versus the variable in that perspective. And these are the things that stand out.
And the two other names that come up are actually the grill names that we
the grill names.
Weber and Traeger. Both of those look pretty poor on this metric as well.
Yeah, listen, I think that's a big EBITDA conversation. And it's the fact that if you came public in 21, chances
meaning because they don't have a lot of earnings.
Correct. Yeah. So if you came public in 21, chances are you had a lot of fixed rate debt. That's just the unfortunate reality. And if you were a grill manufacturer walking out of COVID, chances are you didn't have a lot of EBITDA. So you watched both of those. You got hit by both of those aspects. Fortunately, those low container costs are going to help them more than anyone else as well. So we'll see what that EBITDA does next year.
Sure, meaning as freight costs come down and that normalizes somewhat.
Correct. If there's anyone that got hurt by spending $5,000 to ship things over in a container, that pivoted to $25,000. It was big, heavy grills, that and Peloton bikes.
Right,
But
exactly.
So I think that if we think about it from that perspective, you have the double hit. So you have this fixed cost debt, and then you have the EBITDA. Hopefully the EBITDA starts to improve.
So this gives people a sense, I think, for as you're sort of separating the best and the rest. Should we use this as a launching point to talk Peloton more specifically? It was the poster child for the pandemic, both on the way up and the way down. Where do things stand now?
I was just listening to the last segment. Fixed income, economists, I'm nowhere near smart enough to touch that stuff. What is fascinating to me is how much the consumer led the conversation. Before there was inflation, there was lower promotions.